Good day, everyone. I'm Rhea Jane C. Jerusalem, and I'm here to discuss to you guys about preparation of budget and projected financial statements. So, what is budget? Budget is a description in quantitative, usually monetary terms of desired future result. It is the future of corporate entity that must be the focus of management at all levels during the budget preparation process. So, there are three examples of budgets, which is sales budget, production budget, and cash budget. So, sales budget. It is a prediction of the firm's sale over a specific period based on external and internal information. So, this table below shows that the sales budget of ABC Company for the year ended December 31, 2019. For example, your predicted sales unit in quarter 1 is 6,000 and the price per unit is 100. So if we sell 6,000 unit for 100 pesos each, that's 600 pesos of your sales revenue. So that's what your sales revenue in your first quarter. So the unit sales that were budgeted were multiplied by the selling price to create the sales budget. So production budget is a financial planning related to the units of production that the management think that the business should produce in the upcoming period to match the estimated sales quantity, based on the management judgment related to the competition in the market, the economic conditions, production capacity, consumer prevailing market demands, and past trends. So, the production budget can be expressed in the form of simple equation sales unit added by planned inventory to be maintained in the end and less the inventory in the beginning. For example, we start with a monthly budget with a projected sales unit which is 20,000 on your first quarter. And the finished good inventory is recognition of management's policy against stock out. So we determine those by taking, for example, your predicted 50,000 unit of your quarter two sales unit, you multiply it to 20%, so we've got 10,000 on your finished goods inventory. That's the 20% of 50,000 in your second quarter. So we add this 20,000 and this 10,000, so we've got your total productions from your sales unit. And then we're going to subtract the current period's inventory, which is 4,000. So we're now prepared for production for April, which is 26,000 pesos. We just have to subtract this total production and the beginning inventory finished goods. So the sales forecast and the anticipated amount of finished goods inventory to be on hand are combined to create the motivation budget, which determines the quantity of products that must be made. So cash budget, it is a statement of the firm that has planned inflows and outflows of cash. It forecasts the timing of these cash outflows and matches them with the cash inflows from sales and other receipts. For example, you assume that the selling price is 100 pesos unit sales for each month that is expected to be collected as follows. The month of sales is 20%, the, the amount after sales is 50%, and 2 months after sales is 30%. So as you can see here in the illustration, the January has 2,000 units. Then ang ingon man kay ang price per unit kay 100. So ang kaning sales in pesos, makuha nimo siya by multiplying the units by 100. So, muna ni siya ang 200,000. And then, here in the collection for monthly sales, which is the sales in pesos, i-multiply doon nimo siya to 20%. Kani. So, 200,000 times 20%, then na nimo makuha ang 40%. So, it's still the same process sa the following months. Then, here in the February, masunod na ang collection from the previous monthly sales. Sales in pesos times 50%. So, ang ingon man kay collection from your previous monthly sale, which is the past month. Ang sales in pesos sa imuang January is 200,000. So 200,000 times 50% is 100,000. And still the same process dere. So sa last column, ang ingon kay collection from 2 months prior sales, which is the 2 months before March, which is January gyapon. I-times nimo siya to 30%, which is kaning 60%. Sales in pesos gyapon ni siya kani sa January, 200,000 times 30%, which is 60,000. So ang dire, the total collections from your monthly sales. I-add rin nimo siya starting from collection from monthly sales, which is ang January na 40,000, ang February na 144,000, ang March is 220,000, ang April is 247,000, 275,000, and lastly, diri sa total collections is ang total units starting from January to May is i-add nimo, then mo na nimo total units sales pesos, and then i-add nimo tanan, it's mo na ni siya ang total collection from your sales. Still start yapon diri. A cash budget is a company's estimation of cash inflows and outflows over a specific period of time, which can be weekly, monthly, quarterly, or annually. Pero kani siya by monthly man ni siya. So maybe a company will use a cash budget to determine whether it has a sufficient cash to continue the operating over the given time frame. Projected financial statement is a tool of the company to set an overall goal of what the company's performance and position will be for and as of the end of the year. You forecast or calculate the following reports: the projected income statement and projected statement of your financial position. Projected income statement is an illustration of your anticipated sales, costs, and expenses, while the projected statement of the financial position, in order to create a financial picture that management thinks it can achieve as of the future date. Projected financial statements take into account existing trends and expectations. So here below, as you can see, there are 4 steps for application of the projected financial statements. Step 1 is to forecast the income statement. Step 2 is to forecast the statement of financial position, raising the additional funds needed, and consider the financing feedbacks. So as you can see here in the table, these 3 illustrates the historical average of the millennial company. So the firm is expecting a 20% increase in sales next year, and management is concerned about the company's need for the external funds. The increase in sales expected to carry out without any expansion of fixed assets, but rather through more efficient asset utilization in the existing store. Among the liabilities, only current liabilities vary directly with sales. Using the percent of sales method, determine whether the company has external financing needs or a surplus of funds. So this is how you forecast the income statement, which is the solution of the step 1. The sales has increased to 2,400,000. In order to get this, you multiply the 2 million times 120%. However, the cost of sales it has became 1,440,000, which we got this from multiplying the sales 2,400,000 times 60%. And then you subtract these two for you to get the gross profit. This is actually the historical average of the millennial company, which is this one. For the step 2, forecast the statement of the financial position. This is the continuation of the step 1. As you can see, below this table, this is the supporting computations on how you get these answers right there. This is the increased percentage of the assets. And for the liabilities and equity, it's still the same on the previous illustration, which the formula is already stated below in this table. The accounts payable, the accrued wages, the accrued taxes, and the overall total of this. Your projected income statement is important for making business plans and for attracting investors. It has to be as accurate as possible, even though it's about events that haven't happened yet. Strategies for making projections depend on the age of your business and your own experience. That would be all for my report. Thank you for listening.